All right, so this is Chapter 7, and I'm calling it Part 2. It's the passive investment part. So Chapter 7 is all about portfolio and passive income and losses. And so remember that passive investments are things that investments in partnerships or S corps, or if you directly own rental real estate. Okay, and these are things that you don't materially participate in. So if you are not a general partner or an active manager of one of these entities, then these entities are going to be considered passive to you. All of the income, remember, is considered well, not all of the income, but any income that is ordinary income is taxable annually. So say, for example, you have, you're a limited partner. And your share of the partnership income is $20,000. Well, that is included in your gross income. Okay? Now, it gets trickier with losses, because what happens now with the losses? Well, remember, the key for the losses is the losses may be deductible, but there are 3 limitations, and you have to test all 3 of those. Okay, so first let's talk about tax basis. So tax basis, all right? Remember, losses cannot exceed your tax basis because any excess you have is going to get carried over to the next year. So let's say that you buy a 50% share of XYZ partnership, and you are the limited partner. Okay, so and your 50% share cost you, let's say your 50% share cost you $30,000. So in year 1 basis equals $30,000. So what does that mean? That means if you contribute a truck, and the truck's value is $15,000, now your basis is $45,000. So cash invested, any undistributed income, and your share of the partnership's debts, those things increase your basis. Okay, so what is undistributed income? All right, so let's say now that at the end of the year, your share of the partnership's income is $50,000. All right, so at the end of the year, your share of the partnership income is $50,000. Hold on, I'm going to move my slide up a little bit so we have more room. What happens with that $50,000? Well, that $50,000 is added to your gross income on your tax return, all right? But that doesn't mean that you were distributed out of the partnership $50,000 of cash. So if you get a distribution of cash or other property, that decreases your basis. So let's continue with our example that we've got rolling. Remember, we purchased our portion of the partnership for $30,000, and then we contributed a truck for $15,000, and that gave us a $45,000 basis. Now we've got this partnership share of income. So what happens to our basis now? So now our basis was $45,000. And then we added income of $50,000. So now our basis is $95,000. But what if, okay, so that's great. So I have $50,000 of partnership income on my tax return, but what if I get a distribution of $30,000? Well, so I need cash. Say I need cash. I'm making a down payment on my home, and I want to get some of my investment out of my partnership. So if I get a distribution of $30,000 of cash, now my basis is only $65,000. So that's what, when we talk about our share of undistributed income and income versus distributions, that's what we're talking about. What decreases our basis? Well, we've already talked about these, and we just talked about cash distributions, okay? And then prior year losses also decrease our basis. All right, we talked briefly earlier this semester about at risk, but we didn't talk a lot about at risk. And at risk is a topic that we're going to really, as far as passive investments go, we're going to touch on the least, but I feel like we need to discuss it a little bit. So we already know that we have basis limitations. We also have at-risk limitations. And at-risk limitations have to do with the amount of debt that we have. Okay? So your at-risk amount is the amount of debt that you're responsible for. Oops. I'm going to use a different color or a different type of pen. So it's the amount of entity debt that you are personally liable for. So maybe you guaranteed a loan. And so if you personally guaranteed a loan, then that increases your at-risk amount. There is kind of a special caveat in the at-risk amounts, and it's related to mortgage debt. Mortgage debt is considered qualified non-recourse financing, and so what that means is it is backed by the asset, by the building that mortgage is attached to, but that is still going to increase. So this amount increases at risk. Okay, so mortgage debt increases at risk amounts. All right, let's look at an example. There was an example in here, and so let's do this. So Lon purchased an interest in a limited liability company for $50,000. The LLC has no debt. Okay, so right now, and it says his share of the loss for the current year is $70,000. So at the beginning of the year, what's his beginning of the year basis? His beginning of the year basis is $50,000. What's his beginning of the year at risk? Well, it's also $50,000 because there's no debt. Since there's no debt, his at risk is not increased beyond his basis. Okay? So how much of that $70,000 loss is he going to be able to recognize based on at risk and basis? So based on at risk and basis, he can recognize $50,000 of loss and carry $20,000 forward. Okay? Now, there's also a third limitation. So we talked about basis, we talked about at risk. We also have to worry about the passive activity limitation. And what that says is that losses from passive activities may only be deducted to the extent that a taxpayer has income from passive activities, or when the activity is sold, then you get to recognize that loss or any losses that have been carried over. Okay? And then we've got kind of these passive activity rules. Now, these 7 factors for testing material participation, it's important that you know that they exist. Do not memorize. All right? If someone materially participates or does not materially participate, You'll be told if they do or do not materially participate. So I've included those tests. Those tests are right here. Those come directly from your book, but you will not be required to memorize. So I'm going to write do not memorize. Okay. All right, so we've got another example. So let's talk about Lon again, and this kind of ties us into our last conversation with basis and at risk, and then brings also the passive activity loss limitations in there. Okay, so now we're told that in addition to his interest in the LLC, remember that he purchased for $50,000. In addition to his interest in the LLC, he owns a rental property that produced $5,000 of rental income this year. So he has $5,000. Of passive income. So the question is, how much of Lon's $50,000 loss can he deduct currently? And what happens to the portion of his loss that he can't deduct? All right, so I'm going to move everything up a bit, and let's kind of recap what we had from last time. All right, so remember, so remember he purchased for $50,000. That was his basis and his at risk. He had a loss, Lon's share of loss was $70,000, but what does he do? He breaks that into two pieces. $50,000 and a $20,000 carry forward. Okay. Now we're told additionally that Lon has $5,000 of passive income. So he has a $5,000 passive income from rental. I'm going to move this up a little bit. So based on all of that, kind of where does he end up for the year? So let's we'll talk about what Lon can do. So Lon can deduct $5,000 of loss currently. Lon recognizes $5,000 of passive income. Lon's basis and at risk amounts he carries forward $20,000. For his lawn has a $45,000 passive activity loss carry forward. And that's equal to his 50,000. Oops, that was too many zeros. Minus the 5,000 that he got to recognize. Okay. And remember, this carry forward carries forward indefinitely. And so he just rolls it forward year after year after year until he has passive income to absorb it. All right, so the last topic in Chapter 7 is what's called the mom and pop exception for rental real estate. And so this is designed to help taxpayers. This is designed to help taxpayers who have small amounts of rental property. So maybe you owned a house and then you moved and you wanted to keep that house and keep it as a rental property. Okay, so this is a great kind of exception to the passive activity loss rules. Okay, so what this says is there are several requirements for this. So, taxpayers must actively participate in the rental activity, and then you can deduct up to $25,000 of rental real estate loss against ordinary income. So this is really cool because it doesn't restrict you to passive income. This is against ordinary income. Now, it does have a phase out. So it phases out 50 cents for every dollar that your AGI is over, for every dollar that AGI is over, how do I get rid of that? No. Anyway, is over $100,000. So what that means, I'm going to move this up here, is that this exception is completely phased out at AGI equal to $150,000. Okay, so that's the nuts and bolts of this exception. So if we look at our example here on the slide, so their AGI before considering any income or loss from the rental property is $90,000. So that's below our $100,000 start for the phase out. Their loss from the rental property in the current year is $16,000. So if they have no other sources of passive income, how much of the passive loss from the rental home can they deduct currently? And the answer is $1,600, or excuse me, not $1,600, $16,000. Pardon me, another zero. Okay, so they can deduct this whole amount because of this exception. All right, that completes chapter 7. Thanks, y'all.